Hi everyone, Justin here again, and I want to talk a little bit today about capital credits. Now, capital credits are a bit of an ambiguous thing for a lot of people. They don't necessarily understand what capital credits are, where they come from, and what they mean. So hopefully today I can describe that for you a little bit and give you an explanation of why it's important. Now, some of the business concepts that we're going to talk to today, I'm going to talk at pretty high level about, but I want to try to explain some of them so that you understand why you are a member and what it means to be a member of an electric cooperative. Before I jump into that though, there's someone special I want you to meet, and she's going to give us an explanation of some of the very basic concepts of assets, debt, and equity. I know financial topics and conversations can be a little bit tough sometimes. Not everybody gets all of it, and so I wanted to find someone that I think can give some common sense conversation to it, and so I have my daughter Grace here. Say hi, Grace.
Hi.
So Grace is 18 years old. She's a senior in high school, and she's taking college classes at Pine Technical College, and we're really proud of her. And one of the classes she's taking right now is economics, right, Grace?
Microeconomics.
Microeconomics. And so she's learning about economics, so I wanted to take the opportunity to chat with her a little bit about assets, liabilities or debt, and equity. What is an asset?
Assets are things an individual and company own, like, for example, EC would be the buildings that they're working out of, or the trucks, or power poles, power lines, anything that they own.
Right. So what about debt? Is debt a bad thing?
For me, it would be a bad thing, but for businesses like EC, they can use that for investments or...
Yeah, use it to buy new things that they need for the
Yeah.
company. Yep. What about equity? Where does equity come from?
So that has to do with assets. That's like the paid for portion of
Right.
assets.
So we might, maybe like a company would take their profits from the year before and then reinvest it, and that would become equity in the company.
Right.
Right. How do you like your econ class?
I like it. It's one of the most interesting classes I have, but one of the most challenging.
Yeah. Well, we're really proud of you, Grace. Keep up the good work.
Thank you.
Now that we've developed a basic understanding of what assets, equity, and debt are, I want to give you a visual representation of what that means for East Central Energy and how equity flows through our organization. Let's start out with a very simple concept, and that is revenue minus costs equal profit. Pretty simple concept. Another word for profit is margin. As an organization, if we draw a circle to represent all of the assets of our organization, they can be basically broken down into two categories: equity and debt. Now, the total assets of East Central Energy is about $350 million. 40% of that is equity, and about 60% is debt. And so 40% of 350 is about $140 million, which means we have equity of 140 and debt of about $210 million. Now that debt comes in the form of low interest loans from the federal government and from other private companies. And that those loans flow into the organization and become debt that is paid off as time goes on. Now on the equity side, what we do is at the end of the year, our profits or our margins flow into the company, and they flow in as what's called an allocation. And that allocation is based on how much your power bill was for the year. And also at the end of the year, we do something called a retirement. We retire capital credits, and those capital credits are returned to members as cash. And so let's follow the flow of that one more time. At the end of the year, we have profits. Those profits are allocated and they become equity. Eventually, they are retired and they become capital credits or cash in your pocket. So you might ask the question, why don't we just take the profit and return it straight to the member? You are the owners after all. Well, the answer to that question has to do with the debt. We have a 25-year rotation on our equity and about a 30-year rotation on our debt. The reason we have to hold the equity is the same reason that a mortgage company wants assurances that you're good for the money. In order for us to get the loans on $210 million worth of debt in the form of low interest loans, we have to have equity available to prove that we're good for it. And so by getting that low interest debt, we're able to continue to maintain our electric distribution system and continue to provide reliable electricity to all the services in our service territory. In conclusion, folks, capital credits are really what separates electric cooperatives from every other form of electric utility. You are an owner and you have equity in our organization. Eventually that equity will be returned to you as retired capital credits, but in the meantime, it's being used to secure low interest debt to continue to maintain our system. We appreciate you as a member, and I hope this explanation has given you a little bit more clarity into what capital credits mean and why you see that credit on your bill every year. Thanks a lot for listening, and have a great day.